Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending October 6th, 2017. What a week. What a quarter as we came through the end of this prior quarter and now we're getting ready to kick off Q3 corporate earnings. I was reading the other day where a fear and greed index, I can't remember whether it was Morgan Stanley's or CNN, they closed this past week at 95 on a scale up to 100, 100 being the most greed. And this is a score that is deemed, extreme greed. For the week, the S&P was up 1.2%. It's the fourth winning week in a row. But you guys need to remember that the absence of risk, because of volatility, the VIX is down. It closed the week at 9.65. But low volatility does not mean the elimination of risk. This coming week, we kick off corporate earnings in earnest, I guess. We've got the key global money center banks, which to many extent has been boosting the S&P up higher. JP Morgan and Citi on Thursday, and then we follow that up on Friday into next weekend with Bank of America, Wells Fargo, and then a large regional bank, PNC. So we've got a number of bank stocks that are coming out. I've told our members that this corporate earnings cycle from Q1, 2, and 3 of this year is very strong. We've seen strong corporate growth, low interest rates, low inflation, essentially an accommodative Fed, meaning we've only done 3 rate hikes since 2016, and there's a probability of a rate hike going into Q4 of this year of a little over 78%. But this is already factored into the market, folks. A lot of what has the markets relatively in this benign, let's just go up kind of mode is just what I said, low inflation, low interest rates, easy money. And with the low inflation in the bond market, even with these 25 basis point rate hikes, these 3 of them over the past few years, even with that, interest rates are still very low. And now, Yellen has come out and talked about her BS strategy, which I call her balance sheet strategy. They're already going to start doing reducing the 4.5 trillion in the U.S. Balance sheet. But keep in mind, and what a lot of people don't think about, is that on a global basis, central banks are still growing their balance sheets by about 88% year over year. So while the U.S. is one of the lone holdouts in trying to take stimulus out of the market, or let's say liquidity out of the market, it's probably better said. Globally, central banks are still adding. You got Japan, you got China, you got Great Britain, you got the ECB. So a lot of money, be it a global market now, instead of each country operates on its own, has to go somewhere. And a lot of money is pouring into the U.S., let alone this huge move. I mean, I'm going to show you there are indexes, but we're all at all-time highs. It really is amazing. In fact, we've gone 332 days now in the S&P without a 5% drop. That is number 2 on the length of records as far as how long it's go. The longest is a 333-day rally starting in 1994. So this week, assuming we don't have a 5% pullback, we're going to be the longest record as far as not having a 5% pullback. And understand the markets generally have a 5% pullback every year. We haven't seen one. In fact, we haven't had a 3% pullback in quite some time. So we're just knocking records off left and right, but that's because there's nowhere else for money to go right now, and it's all pouring into the equity markets. A lot of my friends running hedge funds, a lot of my trader buddies on the street, many of them are just loading into shorts and taking some of the pain. I've been telling our members that we've got to take some cash off the table, take some profits, but we still want to play this market as long as it's giving us this up move. Now, you're never going to get out at the high, and you're never going to get in at the low. But right now, the markets still want to give us highs. Now, the other thing that I wanted to point out is for all of you stat fans out there, the Trader's Almanac, the Stock Trader's Almanac, generally says that in years ending in 7 of a presidential year, the stock market has plunged. We had 1987, 1997, and 2007, right? And it all happened in the month of October. October typically brings us some volatility in the first part of the month, and then it starts to settle in. And then we go into November, December, which has been traditionally very favorable for the markets. But we're on year 9 of this secular bull market, and we're starting to get a little bit top heavy. But I do believe that should the Trump administration get through a tax plan, it doesn't have to be the best, but get through a tax plan and then get through some infrastructure spending and then get repatriation of money by U.S. corporations, it's good for another 5% move higher. We can take us up to 26 or 2,700. I was calling 2650 about a month and a half ago, and I'm now upping it to 27 to 2750 if these things come through. If they do not come through, we're going to get an easing of this move higher. We're getting the small cap and mid cap. I mean, the Russell index looks like a looks like a biotech. So let's go in and take a look at these charts here. Now, the only thing that can upset this apple cart is some existential event and or horrible corporate earnings, which would be a surprise. And then, as you guys know, any surprise in the markets do not like that very much at all. We've got a couple of things that have a potential to really upset the apple cart here in this month, in the coming 2 or 3 weeks. One would be the actions on North Korea. They're coming out with they have their Labor Party celebration. I think it's their 72-year anniversary on October the 10th. So most countries, as I say, generally when they have anniversaries, they shoot fireworks. North Korea shoots rockets. So if they shoot a rocket, and Lord knows if they test another bomb out in the Pacific, like that ding-dong eating freak from North Korea talked about, then you'll see the markets have a pretty dramatic sell-off. The other potential geopolitical risk is if Trump comes out and talks about cutting off the Iranian deal, the nuclear deal that they signed. So if he ends that, there could be some unexpected fallout around that with the treasuries and the bond market, and then, of course, the equity market on a potential fear. So we've got a couple of things hanging in the air that are more geopolitical that may or may not happen. But short of that not happening, the markets want to go higher. So we're in this precarious situation where you want to play the bull, but you need to be careful. That's why for our members this week, I'm going to be talking a lot about long volatility strategies, long volatility plays. Whether you have a Reg T account, there's different ways to play long vol. And if you got a portfolio margin account, it opens up the door for a whole lot more. Now, a lot of you that are listening to me this weekend on this update probably got an email on an upcoming Option Masters education series. I can't stress enough the importance of this series. I'm going to be doing probably 25 or 30 hours of education. We're going from soup to nuts, A to Z. We're going to be not just talking about, hey, here's how you set up a calendar or a butterfly or a broken wing or a back ratio or a diagonal or double calendar or these things. You know, the setup part you can get in a book. But what we're going to talk about is not only the setup period, we're going to talk about the trade management aspects of it and then how to run it. And that is so key. The other thing that I'm throwing in there, I actually set up a small account in TOSS. I funded a small account. I think it's like $6,000, $6,200, something like that. And that account, we're going to trade just oil futures. So for those of you that want to get in on this education series, just the oil futures and follow along, and that'll pay for the education in this. And then every session will be recorded, running Thursday night, 8 p.m. You got to get in on it. It's just something that you can't miss. Any one segment of this education on any strategy, other folks charge anywhere from several $100s to thousands of dollars, and I'm only charging just a small amount for the entire run. I'm doing it because I'm updating our video library and moving forward with a lot of our members, and so you can participate in that and take advantage of it. So anyway, enough of that little sales pitch there. I hate doing them, but I think it's just, trust me, guys, I understand trading out there and what would be very helpful. I think this would be most helpful for you. Now, let's look at the chart that I have on the screen here. It's the E-mini S&P 500 futures. It's a daily chart. You can see going all the way back as I move the screen to the right, you can see on the left-hand side of the screen this upsloping channel. We've been in this upsloping channel the entire year, 2017. In fact, it looks just the opposite of the US dollar, which I'll show you here in a minute. We're now in the middle of this channel here. And you can see we're also hitting all-time highs. I mean, we just hit all-time highs every week. I mean, this past week, I think we've hit, or in the month of September, we've hit, I think, 9 all-time highs. And then in October alone, we've hit 4 all-time highs. So we're just continuing to just barrel forward. And now you can see we're up here, and there is absolutely no bearish divergence at all in any of these. There are no divergences in the RSI and the MACD. And that would indicate that any pullback is a buy the dip moment, which is what I've been telling our members all year long. Okay. Now, as far as the details on what is a dip and how do you do a dip versus a pullback versus a correction versus a bear market, I go through that in detail with our members. We'll cover it in the Option Master series because there's going to be an element of charting in it as well. But you can see here where we're sitting. Now, I've got a lot of indicators on the screen, but let's just suffice to say that this market just wants to stay in a bullish mode. You can see these fib extensions off major prior pivot highs and lows. We just busted through the 2.3. We're at the 2.38 at 21 or 25.71. We hit one of my targets at 25.50. And it's just, I don't see this thing abating short of poor earnings or some geopolitical event, as I said. Any pullback is going to be bought right now. So this is the E-minis. If we look at NASDAQ, you'll see the same thing with NASDAQ. NASDAQ, all-time highs. Now, NASDAQ is showing just a little bit more weakness at the top part up here, as we see some money shift from some technology stocks into the consumer cyclical side and into energy and into some healthcare, and as we see moving into interest rate sensitive stocks with interest rates starting to move higher, like the financials. But nonetheless, all-time highs in NASDAQ. If we look at the Dow, let's look at the Dow futures. Dow futures, look at this, all-time highs, right at the all-time highs. Almost no bearish divergence at all on this one either, okay? Again, buy the dip kind of scenario. If we look at the Russell looks like a biotech. It's a daily chart of the Russell. Look at this thing right here. That, my friends, is a daily chart of the Russell. Starting in the middle of August, it just caught fire and took off. Why? Well, this is similar to when Trump was elected. When Trump was elected, the belief was, and we were up at 2 o'clock that morning. I had our members up for those that wanted to participate, and we were trading long, big time, selling gold, going long, many equities. The Dow, we had, I know we had buy orders in on the Dow, and the markets were screaming higher. People were thinking it was going to do just the opposite. But we here knew exactly what was going to happen because Trump was going to do this repatriation, infrastructure spending. He was going to bring inflation back to the U.S. with all these tax cuts, on and on and on it went. And then it just died a sudden death in December, January, when it looked like Trump was going to face a tsunami of haters not to get his program through. And I'm not talking politically. I'm just talking about, do they want his program through or not? Because his program is very inflationary. And with inflation being so low, everybody was saying, okay, now's the time for inflation to come back, forcing Yellen to put more rate hikes in, so forth and so forth. It didn't happen in February, March. And then you could see the markets just struggling through the summer. And then all of a sudden, once they got beyond the healthcare bill, which failed again, into the tax bill, rumor is that they may be able to get something through, although now something is surfacing that it may not. And I don't try and play the politics of it, but you have to play the market reaction and price action based on what policies look the most likely to survive and get through. One is this tax package. It's more of a survival thing for the Republicans than anything else. Although I wouldn't put it past those idiots to muck that up as well. But you can see here this huge move. This is small cap and mid cap, guys. This goes hand in hand with the movement stronger in the US dollar, which I was telling our members is probably going to happen along with the small cap. Small cap is a vote of confidence of the US markets. And I think Goldman Sachs just came out recently and said that for every 1% drop in the corporate tax rate is going to add a little bit more, 25 basis points or more to earnings per share. And they, based on their valuation models, which I think it's more of a theory than anything else, but they did project the S&P, assuming we don't have any of these geopolitical events that I talked about. If they get a tax package through and they get this repatriation, we could see the S&P move up another 5 to 10% from current prices. It's amazing, right? I mean, you're talking, another couple of hundred points to 300 or 400 points if they get all this stuff through. I don't think they will, but even if they get a partial piece through, we're going to continue to see this run, short of, as I said, any one of these geopolitical events. So this is the rut. I mean, just totally on fire. Do not chase this, folks. A lot of rat brain traders have a history of chasing these things. In fact, right now I'm playing it to the downside just a little bit, not a lot, but a little bit. There is no rollover here. If there is any pullback, assuming again we don't have any geopolitical events, there is going to be buyers stepping in willingly. So this is all of the indexes, every one of them at or just a day or two away from all-time highs. Now let's look at the Vanguard All World Index. I put this channel on here. Look at it. It looks just like the S&P 500. We're near 2017 highs. This is the Vanguard All World Index. So not only is the US going strong, but we've got this synchronized effort globally from Japan to China to the ECB, stocks in Europe. Stocks in Europe are more finely attuned to banking stocks because they're more interest rate sensitive. And banking stocks in Europe generally control where the European indexes go. And you can see here just very strong bullish action right here. There is no bearish divergence here, although if we do move a little bit higher, I would expect a little bit of a pullback, which would give the buyers the opportunity to come in and get a better price. Again, short of any geopolitical event. So that's kind of where we're sitting. And then, of course, if we look at the VIX, the index, you can see here we're down near 2017 lows at 8.84, and 8.6 is like a 2-decade low. So we're down very low here. Now we got the VIX futures expiring week after next, and then we roll over to the November futures. But we're in a normalized term structure for volatility. I don't see anything here. I see a lot of potential risk on the horizon. We are going to, and I would highly encourage you to look at long vol strategies as we kick off these earnings. For our members tomorrow night, I'll go through several long vol strategies that we got to be considering here. Okay, so that is the VIX. Treasuries, bonds, they've sold off a little bit on anticipation of the drop in bond market and the rise in interest rates. You can see here we hit a 2017 high literally about a month or so ago, September the 8th. And then boom, we've just given it all up here down in this area here. So the bond market is probably going to settle in around the 2017 open price. And that's kind of where we're going to be for now. If we look at the currencies, well, look at the dollar. As I said, the dollar for the year, look at that. It looks just like the S&P 500, only just the opposite. You can see this channel that the dollar has been in all year long. In fact, the 2017 open is also the 2017 high price for the US dollar. And then we've spent the entire year moving down. I've been telling our members, going back to about the middle of August that I would be ready for a counter trend move in the dollar, and that's what we're starting to get. You can see here that we're challenging this key pivot level right here as I zoom in. Let me just zoom in on this chart. Okay, you can see we're challenging this key pivot level right over in this area here in the middle of August, and we're going to need to get through that. Now the channel, and just with all the shorts sitting in here, we could see the dollar roll right back over. We took out the 50 EMA. It provided support for about 3 days. We've gotten across. The MACD cross is above the zero line, so everything is bullish, but we're still in this, I think, a wider sideways chop pattern. Okay, and unless or until we can take out 94.04 and then hold it with follow through action, including with volume, then I believe the dollar is going to be stuck in this sideways range here. And if we do get a geopolitical event, or if we do back out of the Iran deal, or if North Korea does something unusual, then you're going to see all of these things react. Okay, that is the risk that we have. And then, of course, if we look at the euro, it is just the mirror image opposite of the dollar. The euro broke down, took out its upsloping channel. I've been telling our members that Super Mario Draghi does not want a strong euro, and it'll come back down to around the dollar 116.8 area, and that is exactly what it's doing. You can see the euro spent 3 days underneath the 50 EMA, where the US dollar was 3 days above the 50 EMA. So this is kind of where we're sitting right now with the euro. I will be looking to go long the euro, but not just yet. I want to wait for a signal. The other one that is much more volatile, but I just think longer term is a great bull play, is the British pound. Now, Theresa May has had her issues and problems this past week. She hadn't had a very good week. But you can see the upsloping vector of this channel. Notice the width of the channel. That tells you it's relatively volatile. Generally, when the price action gets at the topper end of the channel or above the channel, it's going to come back in, and that's what it's done. Now, we've been playing this via FXB. And notice the 200 EMA, which we haven't taken out for a while here. Let me just move this 200 EMA down just a little bit more here. You can see the curvature in the 200 EMA where it's curving down, it's kind of settled in, and now it's slowly starting to point back up again. All right. And I have always said in the past that when the 50 crosses the 200, it also acts like a magnet for price to retest that cross point, which would put us at the lower part of this channel, which would be, for folks that didn't get long, would be an interesting spot to pick up some longs. That would put the British pound around 128. All right. And a lot of that is due to the problems with Theresa May and her political issues there. But I think longer term, the pound is going to work its way back up to the 140s. It's just going to take a long, volatile time to get there. So that's kind of what we're playing at the moment, in addition to the dollar and the euro. So that's kind of where we're sitting there. And then, of course, gold. Gold did what I said it would do. Remember, I said up in this area here, get out of gold. Gold hates higher interest rates. It hates low inflation. And gold is reacting as we would expect. It's moved down. Okay, now you can see here in this chart, this yellow line here is the 200 EMA. We're bouncing, we're holding, we're starting to consolidate a little bit, and it looks like we may be getting a signal here, possibly to sell some puts underneath GLD or in the gold futures market. I think gold could run back up to the 1300 area and test it. Same thing with silver. If you look at silver, I was telling our members the same thing. We could run back up to this downsloping trend line here with silver. You can see how far out in time that goes. Silver, we broke out of that line, but we could not take out the prior pivot highs, and then we failed. So now we pull back, and now it looks like we're getting another signal here that we could possibly move up, take this out, and move higher. So we're going to watch it very closely. Oil. We've got a number of trades. We're running a barbell strategy in the oil market. For those in the option masters, or if you get into option masters, like I said, I'm going to put aside 6,000 in Thinkorswim. and we're going to trade just that in oil contracts. And the goal will be to double it in less than anywhere from 7 to 10 months. So for those of you that want to follow along in that, I highly encourage you to come in and see what we're doing with that. So that'll be one of the trades we're going to be doing in the Option Masters Education Series. But you can see gold on this daily chart. We've moved down dramatically. We're testing the 50 EMA. We've had 17 trades in a row that have been successful in oil. We've had 17 trades in a row that have been successful in oil. Some of this is profit taking on this huge move up off the 45 lows. Once we took out that key pivot high there, that was a signal that oil is going to run up. It ran right up to my target area, which was right around 52. You can see that colored bar. I put it in there and I said, that's where we're going to get all the resistance. And sure enough, that's what we got. So now you can see back here, we got the 50 crossing the 200. So that could set a bar for a test down around the 48 level. But I don't see us going much lower than that. Remember, Hurricane Irma, Harvey, and now Nate has played havoc on the refineries, the gasoline market, as well as the oil market. It's done the opposite of what some people have thought, but we traded it really nicely through all of them. So now we're sitting here with this. Let's watch what it does. We've got our barbell strategy working for us, so we'll just play it as it goes. Okay, so that is where we're sitting right now, guys. Members, I will see you Sunday night for our weekly market watch. For all of you other folks, make sure you get in on that Option Masters. It's something I promise you, you do not want to miss. Okay, have a great weekend, everybody, and I will see all of our members tomorrow night at 8 p.m. Eastern Standard. Ciao, folks.